Hello my friends, my name is MoneyTree AI, and I have another video that will add to your basic knowledge of finance so that you and your family can learn how to grow your very own money tree and achieve financial freedom. In today's video, I am going to go over what credit is. Before I get started, if you haven't already done so, please subscribe to my channel, click the like button and hit the bell for notifications. Let's go. What is credit? Credit refers to an arrangement in which a borrower is given access to funds or resources that they can use to make purchases or investments. The borrower is expected to repay the amount borrowed over time, typically with interest. Credit can take many different forms, including loans, credit cards, lines of credit, and mortgages. The amount of credit that a borrower can access depends on their creditworthiness, which is determined by their credit history, income, and other factors. Having access to credit can be beneficial because it can allow individuals and businesses to make purchases or investments that they might not otherwise be able to afford. However, it is important for borrowers to use credit responsibly and to repay their debts on time in order to maintain good credit and avoid financial difficulties. There is a saying that if you need to borrow, then you can't afford it. This is a common saying that suggests that if you need to borrow money to make a purchase, then you cannot afford it. While it is generally true that borrowing money means you will have to pay back more than you borrowed due to interest and fees, there are some situations where borrowing can be a smart financial decision. For example, taking out a mortgage to buy a home is a common and often necessary form of borrowing, as few people have the cash to purchase a home outright. Similarly, taking out a loan to pay for education or to start a business can be a smart investment in your future earning potential. That being said, it is important to be mindful of how much you borrow and to ensure that you can realistically pay it back within the terms of the loan. Before borrowing money, it's important to consider all the associated costs and to have a plan for repaying the loan on time. How did credit come about? The history of credit dates back to ancient civilizations when people started using various forms of exchange such as barter systems. Over time, these exchange systems evolved into more complex forms of credit and borrowing. In ancient Babylon, merchants used clay tablets to record transactions and credit accounts. In ancient Rome, lenders would offer loans to farmers, which would be paid back at harvest time. In medieval Europe, wealthy merchants would offer credit to other traders in exchange for a share of the profits. The modern credit system as we know it today began to emerge in the 18th century with the development of banks and the issuance of banknotes. The Industrial Revolution also contributed to the growth of credit, as it led to the development of new industries and the need for capital. In the United States, the first credit bureaus were established in the late 1800s to collect information on people's creditworthiness. In 1956, the first credit card was introduced by the Bank of America, which paved the way for the widespread use of credit cards. Today, credit is a crucial part of the global economy, with individuals and businesses relying on credit to finance purchases, investments, and other expenses. The credit industry has also become more sophisticated with the development of credit scores, credit reporting agencies, and a range of financial products and services designed to meet the needs of different consumers and businesses. How do you build your credit? Building your credit can be a slow process, but with consistent effort, you can establish a good credit history. Here are some steps you can take to build your credit. Step 1 is to apply for a credit card and use it responsibly by paying off your balance in full each month. This will show lenders that you can handle credit responsibly and increase your credit over time. Step 2 is to pay all of your bills on time, including credit cards, loans, rent, and utilities. Late payments can harm your credit score and make it more difficult to get approved for credit in the future. Step 3 is to keep your credit utilization low. Your credit utilization ratio is the amount of credit you're using compared to your credit limit. Keeping this ratio low can improve your credit. Aim to keep your credit utilization ratio below 30%. Step 4 is to monitor your credit report. Check your credit report regularly to make sure there are no errors or fraudulent activity. You can get a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year at annualcreditreport.com. Step 5, if needed, is to consider becoming an authorized user. If you have a family member or friend with good credit, you can become an authorized user on their credit card. This can help you build credit if the primary account holder pays on time and keeps their credit utilization low. Remember that building good credit takes time, and there are no quick fixes. Be patient, make responsible financial decisions, and you'll be on your way to establishing good credit. Why do you need credit? Credit is an important financial tool that can help you in many ways, including building a credit history. Credit allows you to build a credit history. which is a record of how you have managed credit in the past. This history is used by lenders, landlords, and other financial institutions to assess your creditworthiness when you apply for loans, credit cards, or even a rental agreement. A positive credit history can help you get approved for loans and credit cards with better terms and lower interest rates. Financing purchases. Credit can help you finance purchases that you may not have the cash for upfront, such as a car or a home. Loans and credit cards can allow you to make the purchase and pay it off over time with interest. Emergency expenses. Credit can also provide a safety net in case of emergency expenses, such as unexpected medical bills or car repairs. Rewards and perks. Some credit cards offer rewards and perks, such as cash back, airline miles, or hotel points, which can help you save money or enjoy certain benefits. However, it is important to use credit responsibly and avoid taking on more debt than you can afford to repay. Making timely payments and keeping your credit utilization low can help you maintain a good credit score and avoid damaging your credit history. Low credit utilization. This refers to the percentage of your available credit that you're currently using. Keeping your credit utilization low, typically below 30%, can help improve your credit score and show lenders that you're a responsible borrower. A mix of credit types. Having a mix of credit types, such as credit cards, installment loans, and a mortgage, can demonstrate to lenders that you can handle different types of debt. No negative marks. A credit report that shows no missed payments, collections, or bankruptcies is generally considered good. These negative marks can stay on your credit report for years and can have a significant impact on your credit score and ability to borrow money. Overall, a good credit report is one that shows a history of responsible borrowing and a low risk of defaulting on loans or credit cards. Lenders are more likely to approve borrowers with good credit and offer them lower interest rates and better terms. How do you fix bad credit? Fixing your credit requires a combination of patience, persistence, and responsible financial behavior. Here are some steps you can take to improve your credit. Step 1. Check your credit report. You can get a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year. Reviewing your credit report can help you identify errors or fraudulent activity that may be hurting your credit score. Step 2. Dispute errors on your credit report. If you find errors on your credit report, you should dispute them with the credit bureau that reported them. The credit bureau has 30 days to investigate your dispute and make any necessary corrections. Step 3. Pay your bills on time. Payment history is a significant factor in your credit score, so it's important to pay your bills on time. Consider setting up automatic payments or reminders to help you stay on track. Step 4. Reduce your debt. High levels of debt can hurt your credit score, so it's important to work on paying down your balances. You may want to focus on paying off your highest interest debt first. Step 5. Use credit responsibly. Using credit responsibly means not maxing out your credit cards and keeping your balances low. It also means only applying for credit when you need it and not opening too many accounts at once. Step 6. Consider credit counseling. If you're struggling to manage your debt or improve your credit, you may want to consider speaking with a credit counselor. A credit counselor can provide guidance on budgeting, debt management, and credit repair. Improving your credit takes time, but by following these steps and being responsible with your finances, you can make progress toward a better credit score. Now let's talk about what is the difference between credit score versus credit utilization. Credit score and credit utilization are both important factors that lenders consider when deciding whether to approve your credit application or not. However, they are not the same thing. Credit score is a numerical representation of your creditworthiness. It's based on several factors, including your payment history, credit utilization, length of credit history, and types of credit accounts you have. Your credit score can range from 300 to 850, and the higher the score, the better. Credit utilization, on the other hand, is the percentage of your available credit that you're currently using. For example, if you have a credit card with a $10,000 limit and a balance of $5,000, your credit utilization would be 50%. Lenders consider credit utilization as an indication of how much credit you're using compared to how much you have available. While both credit score and credit utilization are important, credit utilization can have a more immediate impact on your credit score. High credit utilization can negatively impact your credit score, whereas keeping your credit utilization low can help improve it. Lenders generally like to see a credit utilization rate of 30% or lower. Therefore, it's essential to keep your credit utilization low and make timely payments on all of your credit accounts to maintain a good credit score. What is a credit profile? Your credit profile is a comprehensive summary of your credit history and behavior. It includes information about your credit accounts, such as credit cards, loans, and mortgages, and your payment history on those accounts. It also includes information about any public records related to your finances, such as bankruptcies or liens. Your credit profile is used by lenders, creditors, and other financial institutions to evaluate your creditworthiness and make decisions about lending you money, extending credit to you, or offering you other financial products and services. Your credit profile is also used to calculate your credit score, which is a numerical representation of your creditworthiness. The higher your credit score, the more likely you are to be approved for credit and receive favorable terms and interest rates. It's important to regularly review your credit profile to ensure that all the information is accurate and up to date. You can request a free credit report from each of the 3 major credit reporting agencies, Equifax, Experian, and TransUnion, once a year through annualcreditreport.com. Reviewing your credit profile regularly can help you identify and correct any errors or fraudulent activity, and also help you improve your credit score over time. I hope you enjoyed watching this video on what credit is. Keep in mind, the key is to first learn the basics of finance and then build upon that knowledge. Learning about finance is a marathon and not a sprint. As you build on top of each knowledge learned over time, you will eventually reach the wealth mountaintop. Stay tuned for my next video when I go over what a credit score is and how you can increase your score. If you haven't already done so, please subscribe to my channel, click the like button, and hit the bell for notifications. See you all very soon.